Let me ask you a question that will make you uncomfortable. Do you own pieces of the economy, or do you just work for it? Because that distinction, more than your income, more than your education, more than almost anything else, will determine whether you build generational wealth or whether you spend your entire life financially struggling. Right now, roughly 60% of Americans own stocks, either directly or through retirement accounts. The other 40% own nothing. And over a 30-year period, the wealth gap between these two groups isn't just significant, it's life-altering. We're talking millions of dollars in difference. Same country, same economy, same opportunities. But radically different outcomes based on one decision. Do you own assets or don't you? Before we go further, if this conversation about ownership and wealth creation resonates with you, please take a moment to like this video and subscribe to the channel with notifications on. It helps us reach more people who need to understand this fundamental truth about how wealth actually works. Now, I want to be clear about what I mean by ownership, because this word gets used in a lot of different ways and most of them miss the point. I'm not talking about owning your house, though that can be part of it. I'm not talking about owning your car or your furniture or your stuff. I'm talking about owning productive assets. Assets that generate value. Assets that participate in economic growth. Assets that compound over time. Stocks, real estate, businesses, infrastructure. The things that produce income and appreciate in value while you sleep. Here's the fundamental economic reality that most people never internalize. There are two ways to participate in the economy. You can sell your labor, trading your time and skills for wages. Or you can own capital, putting your money to work in assets that generate returns. Most people do the first. They work, they earn a salary, they spend most of what they earn, and they save what's left, if anything. And they never build real wealth because labor income, by itself, is capped by how many hours you can work and how much someone will pay you per hour. Capital is different. Capital compounds. Capital doesn't have a time limit. Capital benefits from leverage and from the productive capacity of entire industries and economies. If you own shares in a company, you benefit when that company becomes more profitable. You benefit when it expands into new markets. You benefit when it develops new products. You benefit from the work of thousands of employees, from the innovation of management, from the scale of operations. And you benefit passively. You don't have to do anything except hold the ownership stake. This is what wealthy people understand that everyone else doesn't. Wealth doesn't come from having a high income. It comes from converting income into ownership. You can make $200,000 a year and stay middle class if you spend $195,000. You can make $60,000 a year and build millions of dollars in wealth if you systematically convert some of that income into assets that compound over decades. Let me give you the math that makes this visceral. Two people, both start at age 25. Person A makes $75,000 a year and invests 15% of income, $11,250 annually, in low-cost stock index funds. Person B makes the same $75,000 and saves the same $11,250. But keeps it in a high-yield savings account. Both are disciplined savers. Both live on the same amount. The only difference is that person A owns assets and person B doesn't. By age 55, after 30 years, assuming 7% real stock market returns and 2% real savings account returns, person A has about $1.1 million. Person B has about $370,000. That's a $730,000 difference from the same amount of money saved. Same discipline, same sacrifice, radically different outcomes because one person owned assets and the other didn't. And if they continue to age 65, the gap widens even more. Person A has about $2.1 million. Person B has about $470,000. The wealth gap is now over $1.6 million. This is not a hypothetical. This is the actual math of ownership versus non-ownership. And yet, 40% of Americans choose, whether consciously or unconsciously, to be person B. They don't own stocks. They don't own real estate beyond maybe their primary residence, which is a consumption asset, not a productive one. They don't own businesses. They just work, save in cash or near cash, and watch the wealth gap grow wider every single year. Now, you might ask, why? If ownership is so powerful, why don't more people do it? And the answer is complicated, but it comes down to a few things. Fear, misunderstanding, lack of access, and structural barriers. Let me address each of these because they're all solvable, but only if you understand them. Fear first. The stock market is volatile. It goes up and down. If you put money in stocks, you can watch your account value drop 20%, 30%, even 50% during a crisis. That's terrifying if you don't understand what's happening. So people avoid stocks. They think they're protecting themselves. But what they're actually doing is locking in a guaranteed outcome of lower wealth. They're choosing the certainty of mediocrity over the uncertainty of volatility that comes with long-term growth. Here's what they miss. Volatility is not the same as risk. Volatility is just fluctuation. Risk is the permanent loss of capital. If you own a diversified portfolio of stocks and you hold it for 30 years, the volatility doesn't matter. It's noise. What matters is the long-term trajectory, which has been up for literally every 30-year period in modern market history. Yes, you'll see your account value drop sometimes. But if you don't sell during those drops, if you just hold, you recover and you compound and you build wealth. The people who actually lose money in stocks are the ones who panic and sell during downturns. They buy high when everyone is optimistic and they sell low when everyone is pessimistic. They turn temporary declines into permanent losses. But that's a behavioral problem, not an inherent problem with ownership. If you own assets and you hold them through cycles, you win. The data on this is overwhelming. Second, misunderstanding. Most people don't understand what stocks are. They think stocks are pieces of paper that go up and down based on sentiment or speculation. And sure, in the short term, that's partly true. But fundamentally, stocks are ownership stakes in businesses. When you own a share of Microsoft, you own a piece of one of the most profitable, innovative companies in the world. You own a piece of their cloud computing infrastructure, their software products, their AI development, their global distribution. You're a part owner of an economic engine. And as that engine becomes more productive, as it grows revenue and earnings, the value of your ownership stake goes up. Not because of speculation, but because of actual value creation. This is why stocks, on average, have returned 10% annually over the long term. Not because people keep bidding them up arbitrarily, but because the companies they represent keep growing and producing profits. When you understand this, when you internalize that owning stocks means owning pieces of productive enterprises, the whole endeavor becomes less scary and more logical. You're not gambling. You're not trading. You're becoming a co-owner of the economy. And the economy, over time, grows. It always has. It probably always will. And owners benefit from that growth. Third, lack of access. For most of history, investing in stocks required significant capital and connections. You needed a broker. You needed thousands of dollars to build a diversified portfolio. You needed knowledge and sophistication. And that meant ownership was limited to the wealthy. But that's not true anymore. You can open a brokerage account online in 10 minutes. You can start investing with $100. You can buy index funds that give you instant diversification across hundreds of companies. The barriers to ownership have collapsed. And yet, people still don't participate. Not because they can't, but because they don't know they can, or they don't believe it's for them. They think investing is for rich people, for Wall Street, for people who understand finance. And that's just wrong. Investing is for anyone with income who wants to convert some of that income into ownership. It's been democratized. The tools are available, but you have to choose to use them. Fourth, structural barriers. And here I want to be honest about something that's often uncomfortable to talk about. Not everyone has the same opportunity to convert income into ownership. If you're living paycheck to paycheck, if you're struggling to cover basic expenses, if you're drowning in debt, you don't have excess income to invest. You're in survival mode, not wealth building mode. And that's a real structural problem. But even acknowledging that systemic inequality creates different starting points, the principle remains. Whatever you can convert from consumption to ownership, you should. If you can invest $50 a month, do it. If you can invest $500, do it. If you can invest $5,000, do it. The amount matters less than the habit. Because ownership compounds not just financially but psychologically. Once you start thinking of yourself as an owner, once you start seeing opportunities through the lens of, how can I own a piece of this, your entire relationship with money and economy changes. Let me tell you about someone I met a few years ago. She was a teacher, making about $55,000 a year. Not wealthy by any measure. But from her mid-20s, she put 10% of her income into a simple target date retirement fund. She didn't think about it. She didn't try to time the market. She didn't chase hot stocks. She just owned a diversified portfolio and let it compound for 35 years. When she retired at 60, she had over $800,000. She never made a lot of money. But she owned assets, and those assets grew, and she retired comfortably with financial security. Compare that to someone else I know who made six figures most of his career, over $150,000 a year at his peak, but never invested. He spent what he made. He had nice things, nice cars, nice vacations. And when he hit 60, he had almost nothing saved. He's still working because he has to, not because he wants to. Same economy, same time period, way higher income, but radically worse outcome because he never converted income to ownership. This is the brutal truth about wealth building. Ownership matters more than income. I've seen people with modest incomes build millions. I've seen people with high incomes build nothing. The difference is always the same. The people who build wealth own assets. The people who don't. Now let me talk about what ownership looks like in practice, because I think a lot of people have the wrong mental model. They think you need to pick stocks, to do research, to watch CNBC, to be active. And that's one approach, but it's not the right approach for most people. Most people should own the market, not try to beat it. They should buy broad index funds that hold everything and just let the economy's growth do the work. This is what I recommend to almost everyone. Put your money in a low-cost total stock market index fund. Own a piece of every publicly traded company in America. You'll own tech and healthcare and finance and energy and consumer goods and everything else. You don't need to have opinions about which sector will outperform. You just own everything and benefit from the overall growth. Add a total international stock market fund for global diversification. Add a bond fund for stability as you get older. That's it. 3 funds. Automatic investments every month. Hold for decades. That's ownership. That's how you build wealth. Not by being clever, not by trading, but by systematically converting income into productive assets and letting those assets compound. At BlackRock, we manage over $11 trillion. And you know what the most powerful product we offer for individual investors is? Index funds. Low cost, boring, diversified index funds. Not because they're exciting, not because they let you tell impressive stories at parties, but because they work. They give everyday people access to ownership of the entire economy. And that ownership, over time, creates wealth. Here's the psychological shift that has to happen. You need to stop thinking of yourself as just a worker and start thinking of yourself as an owner. When you go to work, yes, you're selling your labor. But you're also earning income that you can convert into ownership. Every paycheck is an opportunity to buy a piece of the economy. Every month you invest is a month you're moving from the 40% who own nothing to the 60% who own something, and eventually to the top tier who own enough to be financially independent. And financial independence, that's the goal. Not retirement at some arbitrary age. Not buying luxury goods. Financial independence. The point where your assets generate enough income that you could live without working if you chose to. Maybe you keep working because you love what you do. But it's a choice, not a necessity. That's freedom. And ownership is the path to that freedom. Let me be very direct about something. If you're in your 20s or 30s or even 40s and you're not investing, you're making a catastrophic mistake. You're voluntarily excluding yourself from the primary wealth-building mechanism of modern capitalism. You're working for the economy instead of owning it. And 30 years from now, you're going to look back and realize that this decision, or this non-decision, cost you more wealth than almost any other choice you made. I've talked to too many people in their 60s who deeply regret not investing earlier. They thought they'd start someday. They thought they didn't have enough money. They thought the market was too risky. They thought 1,000 things that kept them from acting. And now they're facing retirement with inadequate savings, dependent on Social Security that won't be enough, unable to stop working because they can't afford to. And all of this was avoidable. All of this came down to not owning assets when they had the time for those assets to compound. Don't be that person. Don't let fear or inertia or misunderstanding keep you from ownership. The gap between owners and non-owners is growing, not shrinking. The people who own assets are building wealth faster than ever because asset prices are rising, because companies are more profitable than ever, because the returns to capital are high. The people who don't own assets are falling further behind because wage growth is slower, because inflation erodes cash, because the purchasing power of labor income is declining relative to the returns on capital. This is not a moral statement. This is not about deserving or not deserving. This is just economic reality. Capital compounds faster than labor. Ownership builds wealth better than work. And if you want to be on the winning side of that equation, you need to own assets. Period. In the next section, I'm going to walk you through exactly how to think about asset ownership across different stages of life, how to balance different types of ownership, and how to structure your finances so that you're systematically converting income to assets regardless of what the market is doing on any given day. And I'm going to talk about the psychology of ownership, because the mindset shift is as important as the financial mechanics. But before we get there, I need you to internalize this fundamental point. The question is not whether you can afford to invest. The question is whether you can afford not to. Because the cost of non-ownership, compounded over decades, is catastrophic. And that cost is optional. You can choose differently. You can choose ownership. And that choice will change your life. Let me break down exactly how ownership should evolve across your life, because the approach is not the same at 25 as it is at 55. The principles remain constant, but the application changes based on where you are in your wealth building journey and what your time horizon looks like. In your 20s and 30s, you have the most powerful asset any investor can have: time. You have 30, 40, maybe 50 years until you need to live off your investments. That time horizon is everything because it allows you to take more risk, to ride out volatility, to benefit from maximum compounding. This is when you should be most aggressive about converting income to ownership and most heavily weighted toward assets with the highest long-term growth potential. What does that mean practically? It means 80% to 90% of your investment portfolio should be in equities, stocks, ownership of businesses, not bonds, not cash, not conservative investments. You don't need conservative at this age. You need growth. And equities are the highest returning asset class over long periods. Yes, they're volatile. Yes, you'll see your account value drop sometimes by 20% or 30% or more. But you have time to recover. You're not touching this money for decades. The volatility is irrelevant. And within equities, you should be broadly diversified through low-cost index funds. A total U.S. stock market fund gives you ownership of every publicly traded American company. A total international fund gives you the rest of the world. That's it. 2 funds. Automatic monthly investments. Never touch it except to rebalance occasionally. This is not exciting. It's not going to make you feel smart. But it's going to make you wealthy if you do it consistently for 30 years. Here's what you should not be doing in your 20s and 30s. Trying to pick individual stocks, timing the market, trading in and out, chasing hot sectors, buying crypto because your friend said it's the future, putting money in a savings account and calling that investing. All of these are distractions at best and wealth destroyers at worst. Your job at this age is simple. Earn income. Spend less than you earn. Convert the difference into broad stock ownership. Repeat for decades. The single most important habit you can build in your 20s is automating this process. Set up your 401k or IRA to automatically invest a percentage of every paycheck. You'll never see the money. You'll never have to make a decision about whether to invest this month or not. It just happens. This removes emotion, removes procrastination, removes the psychological friction that keeps people from acting. And it works. Studies show that people who automate their investing accumulate significantly more wealth than people who try to do it manually, even when they have the same income and the same good intentions. Now let's talk about your 40s and early 50s. This is typically your peak earning years. You're established in your career. You're making more money than you did in your 20s and 30s. And this is when you should be accelerating your conversion of income to ownership because you have both income and still enough time for meaningful compounding. You might still be 80% equities, or you might start dialing it back to 70% or 75%, adding some bonds for stability. But you're still primarily focused on growth. This is also when you should be thinking about diversification beyond just public stocks. If you have accumulated significant wealth, if you have access to certain minimums, you should consider adding other forms of ownership. Real estate, either through rights or direct ownership of rental properties. Private equity or private credit if you're accredited and have access. Infrastructure investments. These asset classes can provide diversification, can generate income, and can reduce correlation to public stock markets. But, and this is critical, you should only add these if you understand them and if they're appropriate for your situation. Don't buy a rental property because someone told you real estate always goes up. It doesn't. Don't invest in a private equity fund because it sounds sophisticated. Many of them underperform public markets after fees. Add alternative ownership only when it serves a specific purpose in your portfolio. Diversification, income generation, inflation protection, access to growth opportunities not available in public markets. What you should not be doing in your 40s and 50s, getting conservative too early. A lot of people hit 50 and panic. They think they're close to retirement, they need to protect what they have, so they shift heavily into bonds or cash. This is a mistake. If you're 50 and you retire at 65, You have a 15-year time horizon, yes, but you also have potentially 25 or 30 years in retirement. You need your money to last until you're 90 or 95. That's a 40 to 45-year total time horizon. You still need growth. You can't afford to be too conservative because you'll run out of money. The right approach is gradual de-risking. Every few years, you shift a bit more from stocks to bonds. By 60, maybe you're 60% stocks, 40% bonds. By 65, maybe 50-50 or even 40% stocks, 60% bonds, depending on your situation. But you never go to zero equities unless you have so much money that you truly don't need growth anymore. And most people don't have that much money. Most people need their portfolio to keep growing even in retirement because they're going to live a long time and inflation is going to erode purchasing power. Now let's talk about your 60s and beyond, the retirement phase. This is when the nature of ownership shifts. You're no longer primarily accumulating. You're starting to draw down. But you still own assets, and those assets still need to generate returns that exceed your withdrawal rate. Otherwise, you're depleting capital, and eventually, you run out of money. Here's the framework institutions use, and you should too. The 4% rule. If you withdraw 4% of your portfolio annually and adjust for inflation each year, historically there's about a 95% probability your money lasts 30 years. So if you have $1 million portfolio, you can withdraw $40,000 in year 1, $41,000 in year 2 if inflation is 2.5%, and so on. This is a guideline, not a guarantee, but it's based on extensive historical analysis. But the 4% rule assumes a balanced portfolio, something like 50% stocks and 50% bonds. If you're too conservative, if you're all in bonds or cash, the rule doesn't work because your returns are too low. You're forced to withdraw more than 4% to maintain your living standard, and you deplete the portfolio faster. This is why ownership matters even in retirement. You need assets that grow, not just assets that preserve. The other critical element in retirement is sequencing. You should have a few years of living expenses in bonds or cash equivalents. This gives you a buffer. If stocks crash in the first year or two of your retirement, you don't have to sell equities at depressed prices. You can live off your bond allocation while you wait for stocks to recover. This is called a bond ladder or a cash bucket strategy, and it's essential for managing sequence of returns risk. Think about it this way. You have your portfolio divided into buckets. Bucket 1 is 1 to 3 years of living expenses in very safe, liquid assets. Bonds, money market funds, CDs. Bucket 2 is 4 to 10 years of living expenses in a mix of bonds and maybe some dividend-paying stocks. Bucket 3 is everything beyond 10 years, and that's mostly in growth assets, equities, because you don't need it for a decade. This structure ensures you can always meet near-term needs without being forced to sell long-term assets at bad prices. Now let me talk about the psychology of ownership, because this is where most people fail even when they understand the mechanics. Owning assets requires a fundamentally different mindset than just earning and spending. It requires thinking about your financial life not as a series of transactions but as a system that compounds over time. When you own assets, you stop thinking about money as something you trade for stuff and start thinking about money as a tool that generates more money. Every dollar you invest is a worker. It goes out into the economy and brings back returns. Over time, those returns get reinvested, and you have more workers. This is compounding, and compounding is the most powerful force in wealth building. But compounding requires patience. It requires the discipline to not interrupt the process. Most people can't do this. They invest for a few years, then they see something they want to buy, so they pull the money out. Or the market drops and they panic and sell. Or they read about some hot investment and they chase it. Every time they do this, they reset the compounding clock. They lose years of growth. And over a lifetime, this undisciplined behavior costs them millions of dollars. I've seen this pattern destroy wealth more times than I can count. Someone starts investing in their 20s, does it consistently for 5 years, builds up $50,000, then pulls it all out to buy a nicer car or go on an expensive vacation or make a down payment on too much house. They tell themselves they'll start again later. And maybe they do, but they've lost 5 years of compounding on that $50,000. If that money had stayed invested and grown at 7% annually, it would be worth over $380,000 in 30 years. But because they pulled it out, they have to start over. The opportunity cost is catastrophic. This is why I tell people, treat your investment accounts like they don't exist. You can't touch them. They're not available for consumption. They're locked away until retirement or financial independence, whichever comes first. The only exception is a true emergency, and a true emergency is not a vacation or a car or even a down payment on a house. It's job loss, medical crisis, something existential. For everything else, you find another way. This mindset, this treating ownership as sacrosanct, it's what separates people who build wealth from people who don't. The people who build wealth are religious about not touching their investments. They live below their means. They drive older cars. They don't take expensive vacations. They don't keep up with the Joneses. They look boring and frugal to the outside world. But inside, they're building a compounding machine that will eventually give them financial freedom. And here's the irony. The people who look wealthy, the ones with the nice cars and the big houses and the luxury goods, they're often the ones who are financially fragile. They're spending everything they make, or worse, they're borrowing to maintain a lifestyle they can't afford. They own nothing. They're one job loss away from crisis. They've optimized for appearance rather than substance. True wealth is quiet. It's assets you own that generate returns. It's not a lifestyle. It's a balance sheet. And the balance sheet is what matters because that's what gives you options, what gives you security, what allows you to weather storms and take advantage of opportunities. Let me tell you about the concept of financial independence, because I think this is the goal everyone should be working toward, even if they don't call it that. Financial independence means your assets generate enough income to cover your living expenses. You don't have to work. You might choose to work because you love what you do or because you want to keep growing your wealth, but you're not dependent on a paycheck. How do you get there? You own enough assets that the returns, whether dividends, interest, capital appreciation that you can realize, cover your expenses. If you need $60,000 a year to live on and you can safely withdraw 4% from your portfolio, you need $1.5 million in assets. That's the number. And that number is achievable for a lot more people than realize it, but only if they start early, invest consistently, and let compounding do the work. Here's a scenario. You're 25 years old. You make $60,000 a year. You invest 15% of your income, $9,000 annually. You get a 3% raise every year on average. You keep investing 15% of that growing income. You earn 7% annual returns on your investments. By the time you're 50, you have about $1 million. By 55, about $1.5 million. By 60, over $2 million. You're financially independent. You can stop working if you want. You've converted labor into ownership, and ownership has given you freedom. This is not a fantasy. This is math. This is what happens when you own assets and you let them compound. But it requires starting early. If you wait until you're 35 to start, the numbers don't work as well. You'd need to invest more aggressively or work longer. If you wait until 45, you're in trouble unless you have a very high income. Time is the secret ingredient. The earlier you start owning, the more powerful the compounding. Now let me address the objection I hear all the time. I can't afford to invest. I'm living paycheck to paycheck. I have debt. I have bills. And I get it. I understand that not everyone is in a position to invest 15% of their income. But here's what I'd say. You can't afford not to invest. Even if it's $50 a month. Even if it's $25 a month. Start somewhere. Build the habit. Because the habit is more important than the amount at the beginning. And here's the thing about debt. Not all debt is equal. If you have high interest credit card debt, yes, pay that off first before you invest. A 20% interest rate on debt is worse than a 7% return on investments. The math is clear. But if you have student loans at 4% or a mortgage at 3.5%, you don't need to pay those off before you start investing. You can do both. You can make your minimum payments on the low interest debt while you invest. Because the returns on your investments will exceed the cost of that debt over time. The key is to avoid lifestyle inflation. When you get a raise, don't spend it all. Take at least half of every raise and increase your investment rate. If you made $60,000 and invested $9,000, and you get a raise to $63,000, invest $10,500. You still have more money to spend than before, but you've accelerated your wealth building. Do this every time you get a raise, every time you get a bonus, every time you have a windfall. Convert increases in income into increases in ownership. This is the discipline that creates wealth. Let me bring this all together with a framework you can implement immediately, because understanding the theory of ownership is worthless if you don't act on it. And I want to be very clear about what action looks like, because it's simpler than most people think and more powerful than most people realize. Step 1. Make the decision that you are going to be an owner, not just a worker. This is a mental shift, not a financial one. It's deciding that from this point forward, you will systematically convert a portion of your income into assets. You will participate in the economy not just through labor but through capital. This decision, this identity shift from consumer to owner, is the foundation everything else builds on. Once you've made that decision, step 2 is to determine your ownership rate. What percentage of your income will you convert to assets? I recommend starting with at least 10% if you're young, 15% to 20% if you can manage it. If you're older and behind, you might need to go higher, 25% or even 30%, to catch up. The specific number matters less than the commitment to consistency. Pick a rate you can sustain, and then sustain it through every market environment, every economic cycle, every personal circumstance that doesn't rise to the level of true emergency. Step 3 is to automate the process. Set up automatic transfers from your checking account to your investment account. Set up automatic investments from your investment account into your chosen funds. Make it so you never have to think about it, never have to make a decision, never have the opportunity to talk yourself out of it. Automation removes willpower from the equation. It makes ownership a background process that runs continuously regardless of how you feel about the market or the economy or anything else. Step 4 is choosing what to own. And here I'm going to be very direct. For 90% of people, the answer is simple. Own low-cost index funds. A total stock market index fund for U.S. equity exposure. A total international stock market index fund for global exposure. A total bond market index fund for stability as you age. That's it. 3 funds. Allocate based on your age and risk tolerance. Rebalance once a year or when allocations drift significantly, and otherwise leave it alone. You do not need to pick individual stocks. You do not need to follow the market daily. You do not need to have opinions about sectors or timing. You just need to own a broad cross-section of the economy and let that economy grow over decades. This approach, boring as it is, will outperform the vast majority of active investors over long periods. Not because it's clever, but because it's low-cost, tax-efficient, and disciplined. Now, if you're in the top 10% of earners, if you've already accumulated significant wealth, if you have access to institutional quality investments, then yes, you can get more sophisticated. You can add alternative assets. You can allocate to private equity, infrastructure, private credit. You can build a more complex portfolio with different return streams and risk factors. But don't do this prematurely. Don't add complexity before you've mastered simplicity. Get to at least several $100,000 in a basic 3-fund portfolio before you even think about alternatives. Step 5 is managing the psychology of ownership. This is where most people fail, so I want to spend time on it. Owning assets means experiencing volatility. Your account value will go up and down. Some years it will be up 20% or 30%. Other years it will be down 10% or 20% or more. This is normal. This is expected. This is the price you pay for long-term returns. The key is to not react emotionally to this volatility. When your portfolio is down 15% in a market correction, you do not sell. You do not go to cash. You do not panic. You either do nothing, or if you have cash available, you buy more because assets are on sale. The worst thing you can do is sell when you're scared, because that locks in losses and ensures you miss the recovery. How do you avoid this emotional trap? First, don't look at your portfolio every day. Check it quarterly or at most monthly. The more frequently you check, the more volatility you see, and the more likely you are to make an emotional decision. Second, remind yourself of your time horizon. If you don't need this money for 20 years, what happens this year is irrelevant. Third, have a plan written down before the crisis. If the market falls more than 20%, I will not sell. I will hold or I will buy more. When the crisis comes, you follow the plan, not your emotions. At BlackRock, when we manage money for institutions, we have investment policy statements that govern exactly how we respond to different scenarios. These are written during calm times, when people are thinking clearly. Then during crises, we follow the policy. We don't deviate based on fear or panic. Individual investors should have their own version of this. A one-page document that says, "This is my allocation, this is my rebalancing rule, this is my response to market downturns." And then you follow it religiously. Step 6 is tax optimization. This is less exciting than picking investments, but it matters enormously over time. You want to hold your assets in the most tax-efficient structure possible. For most people, that means maxing out tax-advantaged accounts first. If your employer offers a 401k with a match, contribute enough to get the full match. That's free money. Then max out a Roth IRA if you're eligible. Then go back and max out your 401k. Then, if you still have money to invest, use a taxable brokerage account. Within these accounts, be strategic about what you hold. Tax-inefficient assets like bonds and actively managed funds should go in tax-deferred accounts like traditional IRAs or 401 kiloseconds. Tax-efficient assets like index funds should go in taxable accounts where you can benefit from long-term capital gains treatment. This asset location strategy can add 0.3% to 0.5% annually to your after-tax returns, which compounds to significant wealth over decades. Also, be mindful of when you sell. If you've held an asset for less than a year, you pay short-term capital gains, which is taxed as ordinary income. If you hold for more than a year, you pay long-term capital gains, which is much lower. This alone is a reason to be a long-term investor. The tax code rewards patience. Use that to your advantage. Step 7 is protecting your ownership from your own future decisions. This sounds strange, but it's critical. You need to make it hard for your future self to undo the work your current self is doing. How? By using accounts that have restrictions. 401 kiloseconds and IRAs have penalties for early withdrawal. That's a feature, not a bug. It protects you from impulse decisions to raid your retirement savings for non-retirement purposes. You can also use what's called commitment devices. Tell your spouse or partner about your investment plan and ask them to hold you accountable. Set up your brokerage account so that selling requires two-factor authentication or a phone call to the broker. Make friction your friend. Make it easy to stay the course and hard to deviate. This might sound excessive, but I've seen too many people destroy their financial futures in moments of weakness. Protect yourself from those moments. Now let me talk about what happens when you actually achieve ownership at scale, because this is the point of the whole endeavor. When you have enough assets that they generate meaningful income, your relationship with work and life changes fundamentally. You're no longer trapped. You're no longer dependent on any single employer or any single source of income. You have options. You have leverage. You have freedom. I've seen this transformation in people. Someone who spends their 20s and 30s and 40s building assets, and by their early 50s, they realize they don't have to work anymore. They could retire if they wanted. And that realization, that knowledge that work is a choice, it changes everything. They stop tolerating bad bosses. They stop doing work they hate. They start making decisions based on meaning and satisfaction rather than money. Or they keep working but they negotiate better terms because they have leverage. This is the real wealth that ownership creates. Not just the numbers in an account, but the freedom to design your life on your terms. To take a year off if you want. To start a business without the pressure of needing it to succeed immediately. To support causes you care about. To be generous with people you love. To retire when you're still healthy enough to enjoy it. These options don't exist if you don't own assets. They only exist for owners. And here's what's beautiful about this. It's available to more people than realize it. You don't need to be a genius. You don't need to be lucky. You don't need to inherit wealth. You just need to start early, invest consistently, keep costs low, stay disciplined, and let time do the work. The math works for anyone with income and the willpower to convert some of that income into ownership. But it requires sacrifice. It requires spending less than your peers. It requires driving a less impressive car, living in a smaller house, taking cheaper vacations, saying no to consumption that feels good in the moment but undermines your long-term goals. This is hard. Consumer culture is designed to make you spend. Social pressure is real. Keeping up with the Joneses is a powerful force. But if you can resist it, if you can delay gratification, if you can optimize for ownership rather than appearance, you win. And the winning is not just financial. It's psychological. There's deep satisfaction in building something over time, in watching your assets grow through your discipline, in knowing that you're creating security for yourself and your family. There's pride in being the person who made good decisions, who was patient when others were impulsive, who thought long-term when others thought short-term. That pride is earned. It's not given. Let me address one final point. The moral dimension of ownership. Some people are uncomfortable with the idea of owning capital, of benefiting from the work of others, of participating in a system that creates inequality. And I understand that discomfort. Capital does compound faster than labor. The returns to ownership do exceed the returns to work. And that does create divergent outcomes. But here's what I'd say. You don't change the system by refusing to participate in it. You just ensure that you're on the wrong side of the wealth gap. If you believe the system should be different, if you believe in wealth redistribution or higher taxes on capital or stronger social safety nets, fine. Advocate for those things politically. But while you're living in the system that exists, use it to build your own security. And frankly, ownership gives you more ability to affect change than poverty does. If you achieve financial independence, you can take lower-paying jobs that align with your values. You can support causes you believe in. You can be politically active without risking your livelihood. Ownership creates agency. Poverty creates dependence. If you want to make the world better, being an owner gives you more leverage to do that than being trapped in paycheck-to-paycheck survival. So let me end with this. The choice between being an owner or just a worker is the most consequential financial decision you will make in your life. It will determine whether you retire comfortably or struggle, whether you have options or feel trapped, whether you build generational wealth or perpetuate generational struggle. The good news is that it's entirely within your control. You don't need permission. You don't need connections. You don't need a lucky break. You just need to decide and then act on that decision consistently over time. If you're watching this and you're not investing, start today. Not tomorrow, not next month, today. Open a brokerage account if you don't have one. Set up automatic transfers. Choose a low-cost index fund. Start with whatever amount you can. $50, $100, $500, doesn't matter. What matters is starting. Because every day you delay is a day of compounding you lose forever. If you're watching this and you are investing, ask yourself, am I doing it right? Am I diversified? Are my costs low? Am I being tax efficient? Am I investing enough? Could I increase my ownership rate by 5% or 10%? Could I cut some consumption that doesn't really add to my life and redirect that money to assets? Always be optimizing. Always be asking how you can convert more income to ownership. And if you're watching this and you've already achieved significant ownership, think about your responsibility to share this knowledge. How many people do you know who are not investing, who are making the mistakes you avoided, who are going to regret it 20 or 30 years from now? Can you help them? Can you explain these principles? Can you encourage them to start? Ownership shouldn't be secret knowledge. It should be common knowledge. And the more people who understand it and practice it, the better. At BlackRock, we've built our entire business on the democratization of investing, on giving everyday people access to the same tools and strategies that institutions use. We've driven down costs. We've created simple products. We've advocated for policy changes that expand access. We believe ownership should be available to everyone, not just the wealthy. And that belief is not just good ethics. It's good economics. When more people own assets, when more people participate in growth, the entire economy benefits. So here's my challenge to you. Commit to ownership. Make it your identity. See yourself as an owner, not just a worker. And then live that identity every day through your choices about spending and saving and investing. If you do this, if you're disciplined about it, if you give it time, you will build wealth. Not overnight, not in a year or two, but over decades. And that wealth will give you freedom, security, and options that most people never have because most people never own. The gap between owners and non-owners is growing. Don't be on the wrong side of that gap. It's optional. You can choose ownership, and that choice will change your life. I've seen it happen thousands of times. I've managed money for people who made that choice and retired wealthy. I've talked to people who didn't make that choice and deeply regret it. The difference is always the same. Ownership or no ownership. That's the variable that matters. If this message has resonated with you, if it's changed how you think about your financial future, please share this video with someone who needs to hear it. Like it, subscribe to the channel, and let me know in the comments. Are you an owner? If yes, what's your story? If not yet, what's stopping you? Because I want to know. I want to help. And I want more people to experience the freedom that ownership creates. Your financial future is in your hands. Not in the government's hands, not in your employer's hands, not in the market's hands. Yours. And the decision you make about ownership, that's the decision that will determine what that future looks like. Choose wisely. Choose ownership. And start today.